Good morning, I'm Bill Hubbard, Chief Economist at Trade.com, and welcome to our weekly financial markets review here on Core Finance. And I'm joined by Stephen Pope, Senior Managing Director at Spotlight. And we're going to talk about commodities. Will this be a short conversation or what?
Well, we can try and put some colour upon what is looking rather sort of pallid and tired sector of the market at the current time.
The last couple of days, what I've been reading from more and more people is, are we seeing a very mini rally in sort of a long-term downtrend?
I think if you look at each commodity across the energies, metals and softs, the agricultural and so on, that there are only a few exceptions where you're starting to see sort of turns that are breaking into more positive, impulsive channels. The majority are either just flatlining or stuck in month, if not year-long corrective channels, and all we're seeing is rotation within that slow decline. At the current moment, there is no genuine way that one could say to an investor, go long across the commodity spectrum, and one will be making money by the turn of the year.
There's two things. One, again, we saw much stronger than expected GDP numbers out of China. So this downturn that Janet Yellen was concerned about 18 months ago, the GDP growth is very well. We saw that pick up in iron ore, and then we saw the massive move on a 2-year high Aussie dollar against the US dollar. So that's been important. And also, I was watching, CNBC the other night, and they were having a gentleman on who's sort of like the Mr. McDonald's and Mr. Kentucky Fried Chicken of the 21st century. He's got about 20-ish type restaurants. And they do anywhere from pizzas to Mexican food and this, that, and the other. And the point that he brought up was how much people are eating bacon-related. And he had a chart, and he showed that pork belly futures are up 80% year to date already. But he said this is a true exception. He said they were very surprised at the type of sandwiches and the type of meals people were eating.
Yes, I mean, I can't speak for his particular client base, but certainly if you think about the Chinese growth numbers you were suggesting, as China has gone through that long economic expansion and created a more affluent middle class, the majority of those people are changing their dietary habits, and they've shifted away from grains to wanting more protein, and that feeds them directly into having pork or beef. So I think you can see with the pork bellies, the lean hogs, live cattle, that those are areas where there are genuine trades that do move higher because it's trying to eat into the demand that's coming from the Far East.
It's quite interesting because I this time last month I was doing a seminar in Malaysia, and several of the Malaysians basically, and I know I'm not supposed to use this term now, millennials, but the 18 to 30-year-olds said the same thing. Yes, they liked their parents' and their grandparents' food, but they wanted beef.
Well, that's absolutely right, because I think it states that they are part of the middle class. It's a representation of being a more affluent sector of society. It's a marker to one's own individual wealth, as much as having a nice watch or car might be. And so that is why we've seen that those particular sectors of the commodities in the agricultural space have been enjoying not just sort of recent demand, but there's been good demand over a number of years now, and it's probably one of the few pocket areas where you could say, yes, we can understand there is a core demand for this product, and so all in all, with general rotations up and down, because that's the way these creatures of commodities are, we will find that those probably have the best chance of moving to higher levels. But again, you've got to be really on top of the ball with what is the weather that's affecting the grain that goes into the cattle feed or to the pig feed, etc. So there are many factors to consider just beyond demand that might be coming from China or Southeast Asia.
Let's see what the charts are telling us, okay, as we see right. Okay. Now, we're talking about crude oil, okay? I mean, again, all these people that started this year thinking we were going to be in triple digits. I mean, whether it be Brent or WTI, we seem to be really locked into this $43 to $50 range now, and it seems like, is the chart telling us that we sort of could be there for a while?
What I think this is showing you is very much that, because at the end of July in St. Petersburg, OPEC and non-OPEC countries who signed up to these agreements are meeting, and they're going to examine how compliant have all the members been to the accord. So that'll be interesting to see who's willing to admit that they.
Well, I keep hearing Libya and Nigeria sort of seem to be doing their own thing.
Well, they got a special arrangement where, because those countries are so war-torn and distressed, that they're allowed to pump more. Libya is sort of beginning to come up on a more steady basis. Nigeria is quite capricious in what it produces from month to month. because there's still terrorism going on in the Delta. But what this chart of oil price volatility is showing is that it's the actual day-to-day movement with the black line has got itself so tightly packed up within these two moving average measures, and it's not finding any ability to break above the 200 level. And I think what that's showing is that this volatility is now essentially flatlining.
Yes.
All right. We're looking at a very granular scale, so it looks like there's some movement. But where is that movement? It's just moving from left to right. It's not up or down
You know,
with any
it's
significance.
interesting you said that, because I know, again, in the seminar last month, a number of people asked me about using charts. And I said, well, the key thing is if you're going to use like moving averages, put like 5, 10, 50, 100, 200. And I said, you do that. You can sometimes see some very strange and probably inaccurate moves.
Yes, I mean, I think there's at the moment in the commodity space, it's almost as though if you want to trade it, you've got to be prepared to becoming like almost an hour trader or a day trader at best. Because if you look at those type of measures, you say, well, it's just winding along, up and down, moving on a flat line, and it's not really showing me anything. Only if you start looking at the minute by minute, hour by hour,
Let's look at
can you see
the next,
some trade.
we go to the next chart here, okay?
Well, this is the actual
Yes.
WTI price itself, and I think we can see that really since February of this year, there was the start of a long corrective channel. Again, general rotation, and that's why...
Would this have had anything to do with the dollar sort of peaking out post-Trump hangover?
To an extent, but I think probably there are other commodities that are more linked to the dollar, which of course is in turn links to what's happening within the US economy. This is really a situation whereby, why is oil going down? Because it doesn't matter what OPEC say about restricting output, as we've seen and discussed and we'll probably see in a few moments, there are other areas where oil can be made available, particularly to the United States consumer. And this reason you see this slow, gentle meander back and forth in that corrective channel is why that previous chart of the volatility was just rotating, but on a sort of flat basis. Because here there's nothing to say it's shaking the market out of its torpor. It's just a slow grind. So here, well, one can just trade the ranges.
Well, let's look at the next chart. And I mean, this is something, you know, at 6 o'clock every Friday afternoon, everybody, at least as you can see in the last 6 months, it's, you know, wow, will the U.S. ever, we were in a sort of a slowdown, but as you can see right now, what are we, 23 for the last 24 weeks, up and up and up, 2.5-year high.
But this is probably a chart that's as close to a dead straight line as one could imagine. There are a few variations, but it's been for a while that you could say, okay, it's the next Friday, so what we'll do is we'll just add another 5 onto last week's measure, and that gives us a good figure of where we'll be for this time. Now you can just tell it's starting to plateau a little. And I think what it's telling us is that even if there is still a sense that OPEC is becoming ineffective, even with its output restriction, what you're finding is that the whole sort of the rig structure in the United States is almost reaching its efficient economic scale.
Okay.
How much more scope is there for new players to come on? Because, of course, they are going to be the players that do need higher prices to prevail to make them economically worthwhile. And so I think that this is beginning to plateau. It wouldn't be surprising, particularly across the summer, if we actually just stick around the 757, 765 space.
I think most people that I've talked to have said the same thing. Probably going to take a vacation till post-driving, mid-September and stuff like that. And also, this probably seems to be where you saw a massive decrease in their funding costs, okay? So now it's a question of, that's been dramatically reduced. They've got full employment. But as you see, again, I think most people I've talked to said they're not expecting much movement at all, say, over the next 2 months.
Yeah, it's almost as though one could say that for this to continue, it's not going to happen because the well effectively is dry in terms of economic returns that can keep coming back to setting up a new rig.
Well, let's see the next.
And this reinforces that point in that we can see from around about January, massive spike up because as OPEC decided they were really going to reinforce this output cap, it just caused prices to trickle up somewhat, and then you could have more rigs coming on and justify the reopening of them and migration of labour from other service sectors back into the energy. However, what's been the path since then? Again, another corrective channel, i.e. the percentage week-on-week change is declining. We've had just one dip below the zero since the turn of the year, but look at that trend. It looks as like we're going to start having hardly any incremental increase on a week-by-week basis.
So let's see what the next chart will show us. Now, this, again, is a situation where I feel any movement we see in gold up or down really is an action or reaction to the dollar, either going up or down.
Yes, this is the commodity that more than any other at the current time is linked to what we feel is the fate and direction of the United States dollar. And we know that it's been dollar moving downwards because the market is becoming increasingly frustrated with the apparent lack of progress with the Trump agenda. The Trumpflation trade is almost beginning to feel a little bit jaded. We don't see the strong economic numbers coming through, so the chances of the Fed moving again are easing back a little.
Now, one thing again, I look at this. To me, this is when we saw the massive backup in global bond yields, okay? So we went well over that 1220 level, okay?
Yes.
And everybody said, yeah, this again was the proverbial safe haven trade. We got close to 1250. But as you can see right now, you know, bond yields are back. I mean, I think the Treasury 10-year now is its 200-day moving average at 226, and you know the big movement of the Bund is over. So again, it's a situation with gold. Is this just sort of in and out day trading?
It is, because I think on a wider horizon, if we were to take it out to say a month basis, you're probably thinking about 1270 down to 1220 is where you're thinking this will run. If you're taking it down to a narrower perspective, and that's the way many commodity deals are being done at the current time, then you're probably thinking that really 1250 is capping it out here.
Yeah.
We've seen before that there's been several times that it's not worth through. The fact is it's cut above the 200-day moving average, and that's a good signal.
Yes.
It didn't dip below it for very long, but look, it's exactly the same pattern as we saw there in May, where it dipped below just for a short period of time, and it's done that same type of thing now. So this probably has a decent chance of maybe going towards 1270, but so much depends upon what are we going to hear in terms of US economic data, what will the Fed tell us, and when they all get together at Jackson Hole, we'll probably have a lot more colour on where this is going to go. Yeah.
I think we have one more chart. Let's see. And this is basically just, as you can see, the day-to-day chart. Now, I guess my question is, in the last couple of days, we've seen earnings from Goldman, Morgan Stanley, and Citigroup, and they were all sort of better than expected, but worse than they were hoped for. And mostly everybody was talking about, you know, the total lack of any bond trading. And I mean, as we saw yesterday, I mean, the VIX traded for its fifth consecutive record day below 10. And there's no volatility and no volume. And I think another thing, again, I think Goldman Sachs has been a public company for probably 35-ish years, at least 35 years. And I do know that in their statement this week, they said basically this was the worst quarter that they have ever had in commodity trading. And I do know that they're having an internal examination on whether they're going to join Deutsche Bank, whether they're going to join Morgan Stanley, Citi, and Barclays, and possibly getting out of the commodity business. So where do you see then the players?
Well, before we went to air, we were talking about the reason why markets exist because people have differing views. Now, we've seen that with oil and the gold, the volatility is almost evaporated. It's just like the equity volatility on both sides of the Atlantic. It's hardly there at all. And when there is no volatility, there's literally no incentive to anyone to do more than just becoming a passive investor, almost a buy and hold and think about it. You see it exactly the same in sovereign bonds. We've now got what you would call slightly semi-distressed corporate debt, not trading a lot more than 100 basis points over where sovereigns would be. So what's the incentive to be engaged there? The commodities is moving away, and so what I think you're going to find is that a lot of big firms are going to start really questioning what is the net contribution to our bottom line, and probably at the moment not very much at all. Is the trend likely to change anytime soon? No, because don't forget, the bigger banks, they have that ability to exit a market, but they can move back in very quickly because they don't unlearn the technology in the trade, and they can always hire more people. But again,
in reference to that last point before we close, one of the things we've always, both of us have been in this business for quite a number of years, there's no free float of people. People don't get laid off in the city and sit around for 5 years. They become a nuclear physicist or something like that. So the point you're talking about, I don't know any people that I knew that were doing commodities at Deutsche or Citi or Barclays that are still waiting for that phone call from the headhunter to say, well, we want to call you back. And so many of these companies are using like smaller sort of peripheral companies to do, they're doing like BIs or investment, we're splitting commissions, et cetera, et cetera, et cetera.
Well, certainly I think you can start to find that finance might well go the way of certain industrial fields, which we call a Hollywood company. You set up a joint venture relationship with people and you come together to execute a certain project. And we call it Hollywood because a film director will always go back and work with a favourite actor, etc. And then they'll stop that project and then go on to the next one. They'll come back together again. This could happen in finance. But what I do think will be that the next generation of traders that are going to be used by the bigger firms are not going to be those who have been laid off in the past few waves.
Yeah.
It's going to be the mathematical quants. It's probably going to be people with a very strong economic basis.
Well, that lets me out.
Let's face it, commodities are the most capricious market of all.
Yes.
When they have got a bit of a tailwind behind them. And for that, it's going to become ever more mathematical as to how these things are traded.
Well, on that totally depressing note, Stephen, let me say thank you very much for joining us this week, and we will see you next month. Thank you very much for joining us, and believe me, it will get better. Bye-bye.